I am Hans.
And I am Franz.
And we are here to pop you up. Today we'll be learning about the German economy, which means we need to keep 4 very important things in mind. 1. Despite large fluctuations in inflation over the short term, economists remain fairly confident in their ability to predict a gradual increase to a 2.4% inflation rate by 2020. 2. After the recent financial crisis, Germany has been steadily recovering, establishing positive GPA growth hovering around 1.8% that is forecasted to remain stable until 2020. 3. With a historically low unemployment rate of 3.9% in the fourth quarter of 2016, it is likely that there will be an increase in unemployment to around 5% in 2020. Und 4. Despite challenges such as Brexit and the refugee crisis, the German economy is still strong, which promotes the idea that if there were a financial turndown, Germany would be better able to adapt than some other countries. Until now. And now I will pass it off to my friend Pat, who has no relation to my brother Franz.
Ever since the hyperinflation that occurred in Germany in the 1920s, maintaining a strong currency has been a hallmark of German economic policy. Despite many challenges to this endeavor, such as the Great Depression, World War II, and the post-war division of Germany, the German government has been able to maintain its efforts to keep its currency, now the euro, strong. As you can see from this graph, Germany's inflation rate from 2011 to 2016 has been fluctuating. This has been caused by a growth of trade and income surplus, which benefited Germany but hurt other countries in the eurozone, causing speculation about whether Germany could retain economic optimism. There's been an increasing trend since 2016, which has been caused by the encouragement of domestic demand and domestic inflation in reaction to Brexit to trim surplus for the benefit of the eurozone. Currently, in 2017, it's at 1.9% and is predicted to go to 2% in 2020. Due to Germany's desire to reduce dependency on devaluation of its currency.
Now, Germany's GDP has been kind of fluctuating around 2%, almost 1% for many years. This is from 2010. You can see it spikes up around 2% around 2011, but there were dips before that, right around 1998 and in 2008 during the global financial crisis. But now we can see after several spikes in 2010 and 2011, it's starting to even out around 1.1% GDP growth. And that's having recovered from a rate of negative 6% in 2008. And right now, the German GDP has stabled out around 3.2 trillion euros, which doesn't sound that great considering the rate is only hovering around 1% for its growth. But when you look at German GDP per capita, it's actually doing pretty well. From 2010, where it was around 38,000 US dollars per person, it has grown significantly in 2017 to 48.5 thousand US dollars per person. This is a jump of more than 30,000 US dollars since 1970, which is one of the largest growths in the world. And what's even better is economists forecast it to grow to around 50,000 US dollars per person by around 2020 due to an increase in population, but also an increase in the working age population.
Okay, so we're here to talk a little bit about the EWG's ETF key players. So these 3, Siemens, Bayer, and BASF, are all generally chemical, pharmaceutical derivation corporations. Siemens and BASF also deal with life sciences as well, and Bayer's a big pharmaceutical corporation. They're all generally, they form the biggest portion of the 68 companies that form up, companies and corporations that form the EWG ETF. And they're all, as you can see, on a downward trend, which is possibly indicative of a negative outlook in the German economy. So Siemens is down, has been for the last couple of years. because of a competition in the gas-fired market, which creates competition for its alternative market, its alternative energy exploration. Buyer is down because of its $66 billion bid from Monsanto, which is also another big life sciences corporation. So they're down. People don't like the possibility of that merger. And BASF is down, which has brought down the stock X 600 index, which is a big European stock index. So that has brought down the ETF, and it puts a strain on other European stocks.
So, German ETF main factors that we have are manufacturing, chemicals, and financial. Now, a lot of people are going to want to buy these. Like, let's say you have $10,000 and you invested. You're not going to see anything turn around in 5 years or 2 years, but you will see it get tripled in 20. So this is a very slow-growing economy. My bad. It's a really slow-growing investment here, so I don't expect anything really fast. So if you're 65, sorry, you're not going to want to do anything with Germany here. So we're very open to investments from foreign countries because of the legislature that we have in place, and we also have a very favorable exchange rate from, let's say, the U.S. dollar. Also, we just because all of this has like a negative trend, it doesn't show exactly what an individual person or business venture will actually be affected by. So,
despite an increase in GDP in the German economy, it's not advisable to invest expecting a short-term turnaround.
Despite all the short-term negatives, currently